Something significant is unfolding here, Danny. Everyone's discussing the gold valuation. Sure, that's fine. They're talking about silver's value too. Okay, understood. But there's something far more magnificent happening behind the curtain. I believe it's an inflation-related phenomenon. My suspicion is that everything that transpired following the GFC is now returning to haunt central banking authorities. The era of inexpensive capital, Danny, is rapidly drawing to a close. And that's the message these precious commodities are conveying to us. We're talking about commodity manufacturers. Consider gold extraction companies, petroleum and natural gas operations, farming producers, iron and steel manufacturing, right? All the traditional sectors have begun showing renewed vigor recently after moving laterally for quite, you understand, several years. All right, 3 to 4 years approximately, and now they're beginning to surge. And this is occurring while the S&P is relatively stagnant, so there's portfolio reallocation happening right before our eyes, and nobody's noticing. Recall back in 2016, gold extraction firms were signaling one direction. They demonstrated considerable strength while the gold valuation wasn't particularly robust, and it was indicating that gold's value would climb higher. So returning to your earlier point regarding silver and gold valuations, platinum, palladium diverging from petroleum's price movement, I believe the petroleum service companies are revealing where oil's valuation will head. I think oil's current price represents a misleading indicator. You're watching Capital Cosm. I'm Danny. Today is December 9th, 2025, and joining me is Brad McFayton from Capital Exploits Insider, my preferred newsletter, for which you'll find an exclusive $1,000 reduction for my subscribers in the description area below. Cannot recommend it highly enough. I've utilized the newsletter for more than 5 years currently. It's what introduced me to and inspired me toward establishing this channel. So I strongly suggest you folks at minimum give it consideration. Link is in the description area below. Brad, much appreciated for joining, my friend. Yes, pleased to be here once more, Danny. Fascinating developments taking place. Hey, there's abundant unusual activity, peculiar signals being transmitted around here, and I think we're going to examine each of these unusual signals, as it were, and attempt to interpret them as best we can. But the major narrative presently at this recording time is the silver valuation. Silver's reached $60, breached that $60 threshold. Here's a silver chart for those requiring the visualization. But indeed, silver is essentially going parabolic at this juncture from a long-range chart viewpoint. Yeah, what's happening? I think there's something larger. Well, gold isn't particularly fragile, and examining platinum, they're performing admirably as well. You examine the platinum extraction companies. There we have it. There's something. Indeed. There's something unfolding here, Danny. Everyone's discussing the gold valuation. Sure, fine. And the silver price? Yeah, fine. But there's something more magnificent happening beneath the surface. I believe it's an inflation-related matter. I suspect everything that occurred since the GFC is now returning to haunt central banking authorities. And we've articulated this for an extended period, and we've been puzzled why the gold valuation hadn't surged for such an extended duration. So we essentially had central banks, the global economy, etc. It extracted itself from that's being diplomatic, in the GFC by essentially just quantitative easing, currency creation, ultra-loose monetary strategy, all that variety of thing. I characterize it, currency creation with reckless enthusiasm. It's an archaic expression like reckless enthusiasm. Godspeed, all those vintage terms. So if we return, you understand, ever since the GFC, any occasion there was a minor setback, what occurred, additional quantitative easing, operation twist, operation whatever. And then it's like, yes, more stimulus was a typical word they employ. Stimulus. That was one aspect. And then naturally along arrived the COVID situation. Oh, fine, everyone can remain home, do nothing, we'll compensate you to remain home. So it's been absolute recklessness by central banking authorities, by governments when it pertains to, fiat currency. They've been operating as if, like, whatever we execute, there's not going to be any long-range inflationary consequences. If there's going to be some inflation, no significant concern. It'll be what? Temporary. There we are. Temporary. Yeah, okay, perhaps for a couple of years, but this is all returning to impact us now. And I don't think anyone's genuinely appreciating it. And I also don't think people are appreciating how elevated the gold valuation is going to reach. It's going to astonish everyone. I'm not going to establish targets on it because people will hold me accountable to, you establish a figure on gold's price. But let me simply state, I think we're going to be astonished. So I think that's what's transpiring at the moment. Gold, platinum, silver, and all the other precious commodities instructing us a valuable lesson. And then naturally bond rates performing. You examine globally, bond rates are strengthening. They're following behind what's occurring with precious commodities. Yeah, there we have it. There's my quick summary. That's what I believe is happening. and where one should be positioned, next 5 years is inflation-resistant securities. Well, precious metals is merely part of it. Commodities, tangible assets, I think is the alternative or the more comprehensive theme. Yeah. And it appears the bond marketplace is no longer accepting what the Fed desires to accomplish. We're scheduled to receive a Fed rate reduction this month here in December, but as you mentioned, bond rates are climbing. Here's the 10-year U.S. Treasury rate. And we've been ascending. Examine all these positive candlesticks for the previous week and a half since November 20th, November 28th, a couple weeks past. So the bond marketplace isn't accepting what the Fed is offering. What does that signify? Yeah. Well, it's the bond marketplace understands better. If you examine bond marketplaces throughout the globe, it's also reflecting the identical type of thing. Well, obviously JGB has taken matters to extremes, but yeah, you examine other bond marketplaces in Europe and so forth. So yeah, nobody's paying any attention to this. The other aspect here, this becomes more intriguing, Danny. So what is your greatest adversary? If you're a high expansion stock, all right, and you possess a PE of 50 or 40 or whatever, select a figure or, let's say select a PE of like 200 odd if you examine Palantir or whatever it is. What is your greatest adversary is the discount calculation. People think, oh, discounted cash flows, that's nonsense. Yeah, not entirely so much. It still applies. So as bond rates climb, the discount calculation climbs, and future cash flow doesn't appear so appealing. You desire, cash flows presently and now become significantly more appealing than what might transpire 10, 15 years from now. You think of NVIDIA, though the greatest adversary is valuations, and examine the S&P dominated by, these expansion stocks, NVIDIA and company. NVIDIA is like 8% of the S&P, so that is the other aspect that nobody's paying attention to. Slowly, the discount calculation is creeping higher and higher, which is a greatest adversary of the whole expansion thing, and AI, the age, and incidentally, it's also the greatest adversary of the whole renewable energy thing. The era of inexpensive capital, Danny, is rapidly drawing to a close, and that's what the precious commodities are conveying to us. Yeah, here's the S&P in green and red, and then the red line is the 10-year rate. So, yeah, the discount calculation keeps diminishing, but it doesn't appear like the S&P is capable of generating adequate momentum to surpass it. Yes. Well, eventually people awaken and go, I'd prefer to be owning the stock on a PE of 10 with a dividend return of 5, 6, 7% than a stock that I might obtain those earnings in 15 years and compensating a PE of 50 odd. I was genuinely shocked. I haven't been examining the broader valuations. I've been examining NVIDIA and company actively, put it that manner, but I hadn't devoted any attention to. I was examining Walmart just as an illustration. I examined the PE of Walmart. It's like a PE of 40. I'm going, what on earth? And this is what's concerning me. It's not merely the valuations of these technology stocks and AI. It's other things like, oh, Walmart, there we are, and everything else that accompanies it. My goodness gracious. There we go. All right, so, yeah. So, there's something unfolding, Danny. It's what we've been articulating for some duration. The era of inexpensive capital is concluded. It's going to astonish us regarding how expensive capital is going to become, which is obviously, that's where inflation's heading or vice versa. And not merely on the demand aspect from the fiat currency aspect, but also from the commodity aspect. Here's GNR. This is an interesting ETF, this one. Yeah, so this is commodity manufacturers. So if you consider gold extraction companies, you consider petroleum and gas operations, you consider agricultural operations, iron, steel manufacturers. Yeah, all the traditional vintage, commodity producing variety of stocks. So in there would be like Exxon, BHP, Newmont, Nutrien, Mosaic, all those varieties of things, various different steel stocks. And they've begun strengthening recently, went laterally for a number of years, okay, 3-4 years approximately, and now beginning to surge, and this is when the S&P is performing not much at all. So there's portfolio reallocation happening beneath our eyes and nobody's observing it. They're all, AI has captured everyone's attention. Yeah, here's the natural resources ETF divided by the S&P. We haven't even commenced with this thing yet. Yeah, that's it. The asymmetry here is absolutely enormous. That's on a logarithmic scale. So this is a nominal logarithmic currently index at .06. You can observe the high was at here 0.02. So yeah, still a considerable distance to travel. And I always prefer to, it's excellent to theorize, etc. But it always returns to executing. What are you executing? Look, I think folks should be reducing dramatically their exposure to the broader equity marketplace. When I state broad, it's not precisely that broad, like the S&P, NASDAQ, and all the quasi-index hugging variety of strategies. and be increasing their allocation to commodity-focused stocks. Now, be it petroleum producers, be it gold extraction companies, platinum extraction companies, agricultural operations, whatever, even developing markets, you could state that's sort of a play on commodities as well, increasing their allocation to those securities, those marketplaces, sectors, and reducing their allocation to the S&P 500. It'll fall on deaf ears, but anyway, and that's precisely what we've been executing. Yeah, you folks have been ahead of the trajectory on this one. I mean, I referenced it at the program's start. I've been reading your newsletter for approximately 5 years now. You were discussing all this material before anyone else was truly a contrarian position in that respect. I want to illuminate onto another chart here really quickly, and it's the fact that silver has essentially moved in parallel to the petroleum valuation. We've got silver here in, the candlestick bars. It's the green and red ones, and then you've got petroleum in blue. And what you'll notice is they essentially move in a correlated manner. Up until today, up until recently, there's been a divergence. So something unusual is transpiring. Patterns that have held firmly together are separating, and one of three things has to transpire here. Either the silver valuation descends, the petroleum valuation ascends, or some combination of the two. And it doesn't sound like the silver valuation is going to descend to meet the petroleum valuation down, because it would have to descend to around $30 silver approximately. That'd be a 50% correction in silver's valuation. I think it's more probable that petroleum ascends back up to retrace this relationship. So that's correct. What's your perspective on this chart? Well, if you were to incorporate platinum in there and gold, it'd be confirming what silver is performing. I mean, I'd be very concerned about what silver is performing if it's merely performing on its own, but it's not. And so what you're identifying there, Danny, is there's a significant theme happening. So precious commodities and a number of other commodities are performing very admirably. Petroleum is not performing so admirably. Yeah, here's all three of them. Gold, petroleum, and silver moving with each other. The only peculiarity is petroleum here in blue. Yeah. I think it's a misleading indicator. What we've observed this year in petroleum, the weakness in petroleum is a misleading indicator. The genuine situation is being portrayed by what's occurring with gold, silver, platinum, and other commodities. I think there was a quotation by Michael Hartnett from, is it Merrill Lynch? No, Bank of America, isn't it? Yeah, stating that where gold and silver proceed, so too will the petroleum valuation. Yeah, here it is. I think this is what you're referencing. Yeah. So he states, soon all commodity charts will resemble gold. So this is from Buffet's Michael Hartnett. He's the chief investment strategist over at Bank of America, and he stated that he thinks petroleum and energy stocks are the optimal contrarian wager for 2026 after lengthy periods of underperformance. He also states that the Trump administration's quote-unquote run-it-hot economic strategy will observe commodities boom and outpace bonds next year, and then he also regards the quote-unquote despised petroleum energy sector as the optimal contrarian position out there after a lengthy period of underperformance. So yeah, straight from the authoritative source that. Yes, I think we can turbocharge that by examining the sector that provides even more value and more upside, and that's petroleum services. Yeah, I know you have some charts you want to examine. Let's proceed and pull those up if I do my little presenting thing. Okay, so Danny, what we have here is a very intriguing relationship. I know that we have discussed this previously, but hey, a little repetition, doesn't harm. What do we have here? So we have in green that is the petroleum valuation. Yellow is the S&P 500. White is the ETF XES, which is the more or less an equally weighted ETF of petroleum and gas service stocks. XOP is more or less an equally weighted ETF of petroleum and gas producers. So you could state it's the average petroleum and gas producer, average petroleum and gas service stock. That's why we prefer examining it. So it's not affected by the market capitalization of, say, Schlumberger or Exxon, etc. So here's the intriguing thing now. Maybe I should, I'm fascinated by this, Danny. Maybe I should exit and get a genuine, I should exit more. So it's indexed back to 0. So you can observe here 23, that's 23%. So petroleum and gas service, the average petroleum and gas service stock since the beginning of September, up 23%. Petroleum down 11%. Okay? S&P is up 7%. Fine. And then petroleum and gas producers flat, which isn't too unfavorable considering the petroleum valuation is down 11%. But this petroleum and gas service thing has us, we're not complaining. We do have our theories regarding what's occurring. But, I guess in 12 months duration, we'll discover what the actual reality was, why these things moved. Has this ever transpired previously, Brad, where the companies move first? Well, yes, it has. We've also discovered that it's transpired with gold extraction companies previously as well. I recall back in 2016, gold extraction companies were performing one thing. They were quite robust. The gold valuation wasn't so much, and it was signaling that the gold valuation is going to ascend higher. So returning to what you were stating previously with the silver and gold valuation, platinum, palladium diverging from what the petroleum valuation is performing. I think the petroleum service companies are revealing to us where the petroleum valuation is going to proceed. I think the petroleum valuation is a misleading indicator. It's been, well, we understand that at least I observed a few hours past, there's record short selling in Brent. I can't imagine West Texas would be any different. There we go. So it's quite difficult to maintain a sector suppressed, like petroleum and gas service stocks. One could, if you accumulated enough capital at it, maintain a commodity future suppressed for some duration. Anyway, the next significant move for petroleum is upward. There we go. I don't prefer to speak in, various different shades of gray. It's black and white. There we go. Now, what have we been executing? We've been, just as a matter of interest, we've been purchasing petroleum and gas service stocks, namely increasing our allocation in drillers. We executed this. Well, this is approximately 6 weeks past. We purchased bore drilling. Naturally, we could have purchased prior to that as well. Yeah, like if this becomes alarming, if you return here, examine this. Bang. We're still, I know. Examine, whichever manner you examine these things, Danny, it's like you're purchasing them significantly below where they were a few years past. Yeah, so that's it. The other one is Weatherford. We purchased Weatherford as well. That's petroleum and gas drilling and services in general. Now, just to remind folks how unloved the sector is, petroleum and gas services relative to the S&P 500. So this is petroleum and gas service index relative to the S&P 500, essentially as unloved as they were if I return here to state 2018, as unloved as they were at the height of the COVID situation. Fair enough there. Examine that. Wow. And yet, these stocks, they've all gone through bankruptcies. Their balance sheets are sound. Earnings are emerging, performing admirably. The other one, which I want to point out, is why we genuinely prefer petroleum service stocks. It is the most detested sector. This is petroleum and gas service stocks. So let's state Halliburton, Schlumberger, Technip, FMC, etc. relative to petroleum and gas producers. You could go Schlumberger relative to Chevron, obtain the identical type of chart. So the essence here is that petroleum and gas service stocks could double in value relative to petroleum and gas producers and still be at the long-term lower boundaries. That's how unloved they are. And what we've discovered, that's one aspect. So the asymmetry offered here, Danny, is absolutely enormous. We think that the petroleum and gas service stocks are revealing to us or confirming what's occurring with, inflation, where the petroleum valuation is going to proceed, with what's occurring in silver, platinum, etc. But there's something else transpiring. Examine this. So now we examine not merely petroleum and gas service stocks. You think that's all we examine? We examine deep value situations across the globe. We've got two portfolios, one where we invest in out-of-favor sectors and marketplaces, another portfolio where we examine high dividend yielding stocks where we think we can obtain, sound dividend returns. And those dividend returns will be sustainable for, 5+ years. Examine what's making our way into our portfolio now. So this is a company called DAF. They have a fleet of subsea service vessels and offshore service vessels. Similar to Tidewater, Helix, those varieties of companies in the US, they're based in Norway. Well, they operate globally, but listed in Norway. Examine this. PE of 5, forward PE of 5 or 6, whatever, dividend return 15%. So these things are making their way into our dividend portfolio where we've typically in that portfolio, we've got cigarette stocks, like British American Tobacco, Imperial Brands, etc. But now we're finding ourselves with highly risky, highly speculative petroleum and gas service stocks appearing there. And that's another one. Examine this. What is that? It's an offshore petroleum driller out of, there we are. I'm such an uncultured person, I can't even pronounce it. Well, I can pronounce it, but I'll do injustice if I attempt. So this is I should get it correct. I look like a fool, don't I? Not being able to pronounce the names of things we've brought into our portfolio, but who cares? This is an offshore petroleum driller. They have a fleet, I think it's six or eight. They have a fleet of semi-submersible drillers, either 6 or 8 semi-subs. So ultra deep water drillers. It's an offshore driller. PE of 12, forward PE of 12, and you're obtaining a 9% dividend return. So now offshore petroleum drillers, the point being, offshore petroleum drillers are making their way into our dividend portfolio. Another one here, this is BW Offshore. We've actually had this for a while. The dividend return was somewhat higher, a few months past, 6 months past. They've got a fleet of FPSO, so floating production storage or floating. So these are the vessels that process petroleum and gas offshore. So if you have a large offshore, let's state it's offshore in Ghana or offshore in Brazil, where it's significantly offshore, there's no infrastructure to bring that petroleum and gas to land or subsea infrastructure, so they have to bring it to the surface, and then they process it on the surface. And then from there, you have shuttle tankers to transport that material, transport the material away. Typically the large VLCCs with large processing facilities on top of on its decks. There we go. So the point being is increasingly we're discovering petroleum and gas servicing variety stocks making their way into our dividend portfolio. And petroleum and gas service stocks have typically been, where we've been overweight in the asymmetric portfolio, and we're still purchasing. So Danny, it's extremely difficult restraining ourselves and not becoming too overweight on petroleum and gas service companies. That's the point. We just can't restrain ourselves. Yeah, there we go. So that's what we're observing. That's what we're executing. There's a number of other things we're examining as well, but that's the main thing we're observing at the moment. If you don't mind me asking, how much allocation do you folks have in your petroleum and gas sector allocation compared to the rest of your portfolio? Well, in our asymmetric portfolio, we've got approximately, to the energy sector, which includes coal, and it also includes tankers, it's approximately 60%. To petroleum and gas service stocks, approximately 20% exposure. Now, petroleum and gas service stocks are not merely offshore petroleum drillers. Offshore petroleum drillers would be approximately 5%. Then you have subsea service stocks, which like Technip FMC, like FTI is the code. Then you have pipeline or drill pipe manufacturers like Vallourec in France. Then you'd have things like SBM Offshore and BW Offshore FPSO operators. So in total, our petroleum service, the broad service sector, would be approximately 20%. Energy, 60%. And it's not that we're, petrol enthusiasts, not that we, consume coal for breakfast, or it's just that that's where the value is and that's where we discover ourselves. So we examine the U.S. marketplace, like you remove the energy sector in the U.S. marketplace, it's like there's no value, nothing. I think there's only one other stock we have that's not petroleum and gas or energy related. They produce chicken eggs anyway, beside the point, which is a commodity in and of itself too. So I didn't even think of that one. There we go. Yeah, there we go. Well, appreciate you being generous, Brad, by, showing the audience some of the material that you have allocated in the portfolio. And if you folks would like to participate in the portfolio, this is just a small sample of what's in that asymmetric and dividends portfolio. You've got 2 different portfolios at the newsletter. So if you folks would like to unlock all those high value names, we do have a special $1,000 reduction below. And again, I highly encourage you folks to, at the very minimum, give it consideration. Brad, you and Chris are I'm subscribed to a number of newsletters, but your newsletter is bar none my preferred. It's the one I utilize first and foremost for all of my research above anyone else. So examine it, folks, if you're interested. Brad, I'm going to close things out by asking you a question that I've been asking a number of my guests this month as we head into the new year. And that is, looking into 2026, if you're able to make 3 predictions for the year ahead, what would those 3 predictions be? And I'm not going to hold you accountable to them, but just for amusement, just for what? Regarding financial marketplaces? It could be financial marketplaces. It could be anything else. Well, I guess the sun's going to rise tomorrow or next year. Next year will be another fantastic year. Okay. So the energy sector will significantly, from a broader viewpoint, commodity-focused stocks will outperform the S&P 500 and dramatically so. Whether or not the S&P 500 declines or enters a bear marketplace, who knows? But yeah, so overall, the broader commodity marketplace outperforms. The best performing sector, or at least in the, the top 10% of sectors, call it what you will be petroleum and gas services. Nobody's discussing this sector at all. Nobody, 0, nothing. You might hear a bit of energy, that's it. And the gold valuation astonishes everyone. I hate establishing targets and valuations on things, Danny, because people will state, oh yeah, Brad stated gold at $8,000 by the end of 2026. But it'll astonish everyone. Is that 3 predictions? I think the one prediction I would make, and that's what we're positioned for, is energy to outperform, particularly in the petroleum and gas service sector. Yeah, and as we observed earlier today, Bank of America concurs with you, so you're definitely not alone. So interesting. I recall reading Michael Hartnett's material I'm certain he was with Merrill Lynch, and it was back in 2000, and it was the Bank of America commentator way back, and that's like 25 jeepers. I examined myself on the screen here. That's 25 years past. Well, it appears like it, Brad. Yeah. I'd hear back then somewhat more. Yeah. What are you executing? collecting Pokemon cards back then, Danny, probably. Yeah. Well, hey, I mean, don't laugh. Some of these cards are valued at a considerable amount now. Yeah. Yeah. It's an inflation narrative. It's a speculative boom. So collectibles ascend in the process, everything except fiat. Yes. Yes. There we go. Appreciate it, Danny. Wonderful to converse. Have a wonderful Christmas. Yeah, you as well. Merry Christmas, Brad. Folks, hope you're enjoying your holiday month leading up to Christmas. Happy New Year, all that. Appreciate you so much for joining, Brad. Folks, appreciate you so much for watching. And again, if you want to take advantage of the $1,000 reduction, you're not going to find the reduction anywhere else. Click on the link below in the description area or the pinned comment and get started now. Unlock the plethora of names and stocks that Brad and Chris have put together and so much more. In my opinion, it is worth the annual cost of entry because in my case, I've made all that up and many folds throughout the years. So, all right, folks, well, hit that like and subscribe. Comment below. Go, Brad, go in the comments section. Let me know what you think. Let me know whether you agree or disagree with Brad. I do, in fact, read all the comments. So, drop me your thoughts below. Subscribe to the channel, like subscribe, comment. All that helps in pushing this video, this channel, and this message out in the algorithm. So with all that stated, I appreciate your time and I will catch you later. See you folks.